So eligibility. Here's
Hmm.
one of the great pros of this. Eligibility. When you have an employee sponsored, you have to have a job that offers it. There is requirements, right? Because with a brokerage account, like if you want to invest in Apple, you got to be 18. Okay. But this is not the case for the Roth IRA. The Roth IRA allows you to invest literally at any age. The only requirement is that you have to have taxable income. I tell my students because they don't know what that means. That means working on the books. That means that your job is taking out taxes. And you can do this at any age and open up the Roth IRA. Now, not to like dive too deep, and this could be a completely different episode, but like say you have a child that works for your business, right? Like my daughter paper shreds for a couple dollars an hour, helps me pick out thumbnails, tells me if I need to shave. She's like my little she helps me clean up and tend to the office. I pay her out of the business. She has earned income that she's under the standard deduction, so that's all tax free for her. I write it off and get the tax deduction. She's going to put that into her Roth IRA, and it is going to grow from age 3 years old and on. You do not need to have a job. Do not need to have an employee sponsored account, and you don't need to be 18, which is probably one of the pros and one of the biggest things, not misconceptions, or things that people don't know. If you are 16 years old and you're working in the pizzeria on the books, or if you're working at Ralph Italian Ices, or you're lifeguarding, or you're a camp counselor, and you make $2,000 over the summer, you can turn around and throw 250 bucks, 400 bucks, 500 bucks and start your Roth IRA today.
And if you're 16, listen to the Average Money podcast. Props to you, my guy.
I'll give it to him. I'll give it to him as a bonus on the test. Like
Yeah.
I'm gonna ask you a question from the podcast yesterday on the test tomorrow. So
There
you
you
better
go.
listen, and you better listen good.
Boom. I love it. Yeah, no, that's huge. Like the fact that you can, like you mentioned, get started under 18 is a big ordeal because as we've talked about on this podcast before, and if you're in the finance space, you've heard this plenty of times, but compound interest is on your side and it's works the best when you start the earliest. The earlier you get started, the more compound interest can work for you and grow your money even more.
And I think at the end of the episode, we'll talk about how we invest in ours and give a couple
Yeah.
examples because it is different. But what are some of the other big pros for you? Like you want to explain the tax implications of this?
Yeah. So, I mean, to keep it really short and sweet and in layman's terms, basically how this works is when you put money into your Roth IRA is an account, right? So you're putting it into, like Brad said, it's like a checking account, except it's an investment account. So that money goes in, and when you put your 200, 300, 400 bucks into your Roth IRA, that money sits in what's known as a settlement fund. So once you put the money in the Roth IRA, you're not technically invested yet. You have contributed to your Roth IRA, but you have not officially invested the money that's inside the Roth IRA. See, the Roth IRA is a vehicle. It's not necessarily an investment. So it's very, very important to understand when you put money and you go and open up your Roth IRA. Let's say you listen to this episode and you've never heard of the Roth IRA before, and you go to Vanguard and you open up your Roth and you contribute your 200 bucks and you think that you're finished, you're done, or you're not. You have to invest the money in something. And like Brad said, we'll talk about that in a little bit. But the cool part about this is first I need to explain how taxes work with investments. So if you take $1,000 and you go buy, an index fund, an ETF, or a stock. For example purposes, let's just say you go buy $1,000 in Apple. That's a very popular, well-known company. So when you go buy $1,000 in Apple and you own Apple for, let's say, 2 years, and Apple goes up, let's say a certain percentage, 10%, whatever. So now let's say you made $10 on your investment. Let's say $100 on your investment. So now on your investment account that you bought Apple with for $1,000, you made $100. So now you have $1,100 sitting in that account. What gets taxed on that whenever you would sell realize your gains? Basically, whenever you would sell and take that profit, so you took the profit, that $100 is what gets taxed. You don't get taxed on the 1,000. I get that question a lot. That's why I wanted to kind of break that
Mm-hmm.
down and explain that. A lot of people think that once you put money in and invest it, that you're paying taxes again on the money you put in. That's not true. You only pay taxes on the money that you have made. So that $100 you made from Apple, that's what gets taxed. So now that I think we have that understanding said, with a Roth IRA, it works a little different. And this is probably one of the main reasons why Brad and I love this so much, is because let's use that same example. You go put $1,000 into your Roth IRA you just opened. You buy Apple, and Apple makes you $100, and then you sell it and you never use it again. I wouldn't recommend that, but for example purposes, the cool part about a Roth is you don't get taxed on that $100. Mm-hmm. So think about that for a second. Think about you made your $100 over a year or two, but think about what happens over a span of 20 or 30 years, and you are continuously putting money in every single week, month, year, whatever, however you invest your money into your Roth. That is the power of the Roth IRA, because as we all know, compound interest, and you've all seen the compound interest calculator. If you put $500 every single month for 20 years and an 8% return, you're going to have $1.2 million in your account, whatever it comes out to. The amazing part about that is with the Roth IRA, when you turn 59 and a half, and there's so many tangents I can go with this, but
yeah.
So with a Roth IRA, it is a retirement account. So you can't pull the money made out unless you want to pay taxes and a penalty. We don't recommend that. You can pull the contributions out, but
your growth is stuck to your 59 and a half. Your contributions, the money you put in, is not. But
yes.
Continue.
So basically what I'm getting at is the power of the Roth IRA is when you go to pull that money out at 59 and a half and you want to start living on that in retirement, you don't have to pay any taxes on that money. Now, one other point I did forget to mention is the money that goes into the Roth IRA, that is taxed money. So the money you're putting in there is taxed. So like money you receive in your direct deposit from your job, after that's been taxed, that's the money you put in to a Roth IRA, where versus like a 401k or a traditional IRA, that money goes in pre-tax. So that money goes into the accounts before your employer takes the taxes out, or before, if you own a business, before you have to pay your taxes on that amount of money.
Yeah, and you are literally earning tax-free money.
And like, so for some people who are listening that may just have stumbled upon this episode and aren't as familiar with how taxes work and how investing works and all that stuff, like, just listen to us. That is powerful.
Yes.
That is a powerful vehicle, because usually whenever you're investing and, let's say you have some massive capital gains, meaning you have some massive growth, let's say you invested $1,000 and then it 10x turned into 10 grand. Well, you owe taxes on $9,000.
Yeah.
If that does that in your Roth IRA over a span of 20, 30 years, you don't owe any taxes on it. That's free money. And
if you make dividends, that's tax-free. If you are advanced and trade options in your Roth IRA, the premiums you collect, tax-free. And that is the greatest thing ever. And it's even better, though. It gets even better. And I didn't realize this until I was married and had kids. I didn't realize in your 401k, at a certain point, you have to start taking money out of it. You can't let it sit and grow forever.
Yeah, isn't it called RMDs or something like that?
Yeah, it's a minimum required distribution.
Yeah.
Yes. In a Roth, that is not true, which, okay, you're saying we want to grow this account and we're never going to want to touch it? Yes, because it has some legacy benefits that other accounts don't have. Here is something that's very, very important to me. And I almost treat my Roth as kind of like part of my life insurance policy, if you will. Because if you are married and you die, you can take your entire Roth IRA and give it to your spouse, and they absorb it like theirs, and it continues to grow for them tax-free, just like it was theirs. So if I die, Tara's Roth IRA is going to be just wiped out. It's going to be just doubled. It's going to be fantastic. With your kids, it's not as sweet. They are going to get that money tax-free, but there will be minimum distributions over time that are going to have to go to your kids. but it stays tax free even upon your death, which is really, really awesome.
Yeah, I mean, the legacy part of that too is it's honestly something I don't really think about that often.
yeah.
But when you bring it up like that is a pretty amazing, benefit to the Roth IRA because as we've stated before, you never know what's going to happen.
Yeah,
It's
and my
nice to have.
my personal brokerage account, like Tara's my beneficiary, but she's gonna have to close that account and take capital gains on that.
Right. And you got to pay taxes on that.
Yeah,
Yep.
so I mean, and like I said, we're not tax experts, but like
Right.
that to me just was another major pro. You like to sum up the pros. You don't have to be in an employee sponsored thing. You don't have to be 18 like a brokerage. You are not going to have minimum random required distributions. You could take your contributions out later. So if you're contributing over time and then you need some of that money back, you could take some of that money back. And we'll talk about the caveats to that. It passes on to your kids. Everything in it's tax free, dividends, capital gains. You can borrow against it. You can invest in real estate, and you can grow your real estate portfolio tax free inside a Roth if you have a very special one. Like, these are all amazing things that's why it really makes it important to me to have everybody know. But there are cons.